Welcome to Eggs Invest, your ultimate guide to navigating the intricate world of real estate investing. I'm your host, and today we're discussing a cornerstone of successful investment strategies: risk mitigation in the UK property market. We'll explore essential strategies such as diversification and liability management. These two approaches can help you protect your investments and position you for long-term success. Before we dive into the strategies, it's vital to establish a common understanding of risk in real estate investing. Risks can be broadly categorized into several types. Market risks. Market risks involve fluctuations in property prices and rental yields due to economic trends, interest rates, and regional demand changes. Recent events, such as the pandemic's economic impact, have shown that different sectors can behave unpredictably. For example, while residential properties adapted relatively well, commercial properties saw a significant decline. Liquidity risks. Real estate is typically considered a less liquid asset, meaning it may take time to sell a property without a discount. Economic downturns can worsen liquidity risks, which is crucial when you need to access cash quickly. Operational risks. Day-to-day operational risks include dealing with tenant vacancy rates, potential property damage, and regulatory compliance issues. These risks can indirectly affect your income stream if not addressed promptly. Financial risks. This category includes risks from borrowing, such as interest rate fluctuations on mortgages. If interest rates rise, your fixed cost outlay could increase significantly, impacting cash flow. Geopolitical risks. Tax changes, regulation shifts, and broader political actions like Brexit can impact property values. Current political climate and decisions will affect investor confidence and market stability. Understanding these risks forms the basis for robust risk management strategies, critical for any investor in today's dynamic UK market. Now let's focus on diversification. Why is this strategy essential, and how can it effectively mitigate risk? Diversification is the practice of spreading investments across various asset types and geographical locations to minimize exposure to any one property or market. The idea is straightforward. The more diverse your portfolio, the less you expose yourself to the downfall of one asset. Let's focus on types of diversification. Types of diversification. Asset class. Diversification. Investing in different types of assets reduces sector-specific risk. Here's how different sectors can act independently. Residential properties, generally more stable and less affected by economic downturns because people always need housing. Commercial properties often provide higher yields but can become vacant in economic recessions as businesses downsize. Industrial properties, warehouses, or manufacturing facilities are becoming increasingly relevant due to the rise of e-commerce. Investing here could provide resilience against retail downturns. Geographical diversification. Different areas can experience distinct economic environments. While London is expensive and competitive, places like Birmingham, Leeds, or smaller towns could present more affordable entry points and potentially higher returns. Consider investing in areas where regeneration projects are underway. These areas often yield substantial returns as infrastructure improves. Investment vehicle diversification. Engage with various investment vehicles such as direct property investments, traditional ownership of residential or commercial properties, REITs, real estate investment trusts, provide exposure to real estate markets without directly owning properties. Crowdfunding platforms allow fractional ownership of real estate, enabling you to diversify into various sectors without massive capital requirements. Now that we've defined and understood the importance of diversification, let's explore some actionable strategies to implement it effectively. 1. Conduct thorough market research. Utilize comprehensive data from property analytics platforms like Rightmove, Zoopla, and Land Registry to analyze market trends and price movements. Assessing property history, area demographics, and local amenities can guide your purchase decision. Areas with schools, parks, and transportation links tend to be more stable. 2. Stay informed on macro and microeconomic trends. Macro trends can include national economic indicators such as GDP growth, unemployment rates, and inflation. Microeconomic trends focus on specific neighborhoods. For instance, if a tech company announces plans to set up in a city, housing demand in that city may increase. 3. Diversification by property type. If you're predominantly focused on single-family homes, explore investing in buy-to-let properties, student accommodations, or even vacation rentals. Example: a mixed-use development can create multiple revenue streams, from retail leases below residential units, balancing out any tenant losses. Or utilize technology for data analytics. Property management and investment platforms can provide real-time data on occupancy rates, maintenance costs, and market performance, allowing you to make timely decisions. Use predictive analytics to assess potential market shifts based on historical data. Let's dive into liability management, a crucial aspect of risk mitigation that focuses on understanding and managing your financial responsibilities. 1. Identifying liabilities. Mortgage liabilities. Understanding your debt and its implications is vital. High mortgage debt, especially with fluctuating interest rates, can be risky. Utilize conservative leverage by aiming for a lower debt-to-equity ratio to ensure long-term financial health. Operating liabilities. These include costs associated with property management and maintenance, such as utilities, repairs, taxes, and management fees. Be proactive by budgeting for these costs and regularly reviewing them. Sudden burst of maintenance issues can push expenses beyond what you allocate, impacting profitability. Legal liabilities. As a property owner, you must adhere to local laws regarding safety, tenant rights, and property conditions. Ignoring legal considerations could result in expensive lawsuits and fines. Post. Here are some actionable strategies to manage liabilities effectively. 1. Structuring your financing wisely. Use conservative financing options, such as traditional fixed-rate mortgages, rather than variable rates, which can leave you vulnerable to rising costs. Explore mortgage products that allow for flexibility, such as offset mortgages. 2. Regular financial review. Conduct quarterly or biannual audits of financial performance against your projections to identify discrepancies early. This involves assessing cash flow, mortgage terms, and overall budget adherence. Investigate refinancing opportunities when interest rates drop. 3. Comprehensive insurance coverage. Assess your insurance needs regularly. Make sure you have coverage for property damage, natural disasters, vandalism, liability insurance, tenant injuries on property, rent guarantee insurance should your tenants fail to pay their dues for any reason. 4. Implementing a maintenance plan. A strategic maintenance plan helps prevent larger issues down the line. Regular property inspections can identify problems early, thereby saving costs. Consider setting aside a percentage of annual income for unforeseen repair costs. Being prepared for unexpected occurrences can set you apart from less proactive investors. Here's how. 1. Establishing a contingency fund. Aim for a fund that covers at least 3 to 6 months of operating expenses, including mortgage payments and maintenance. This fund can support you during tenant vacancies or economic downturns. Example: if your monthly expenses are $2,000, having $6,000 to $12,000 set aside can be a lifesaver during challenging times. 2. Developing a legal support system. It's crucial to have access to legal expertise about property law. Engage a solicitor or legal consultant specializing in real estate to keep you updated on evolving regulations and compliance requirements. Having a lawyer who can assist in drafting or reviewing lease agreements can safeguard against future disputes by ensuring clarity and legality. To wrap this insightful discussion, let's outline how to create a comprehensive risk management strategy that integrates both diversification and liability management effectively. And risk management plan development. Document your entire risk management strategy, addressing all areas we covered today: market risks, financial assessments, diversification, and liability management techniques. Include action steps and timeliness for reviews. 2. Continuous education and training. Real estate is a shifting landscape. Regularly attending seminars, webinars, and training can equip you with the latest trends and risk mitigation techniques. Use platforms like LinkedIn Learning, Coursera, or even YouTube for up-to-date information. 3. Engage professionals. Assemble a robust team of professionals, including real estate agents who specialize in your investment areas, financial advisors for in-depth financial analysis, property inspectors and maintenance teams who can provide reliable support for your properties. In conclusion, risk mitigation in real estate investment is not just a single task, but a comprehensive, ongoing process. By focusing on diversification and effective liability management, You create a resilient investment strategy that reduces your exposure to market fluctuations and operational challenges. Remember, diversify, spread your investments across different asset types and geographical markets to reduce instability. Manage liabilities. Stay on top of your financial obligations and always prepare for the unexpected. Educate yourself. Always keep learning about industry trends and updates, ensuring your strategies remain relevant. Thank you for tuning in today on Your Podcast Name. Hope you found this discussion informative and actionable. Please subscribe to our podcast for more insights into real estate investing. Don't hesitate to reach out with your thoughts and questions. Till next time, keep investing wisely